let me start with a little bit of context, because I think it's really important we understand the context of the global economy and some of the trends that have been happening that led to this event, and how come there is a level of interconnectedness between the different economies. I presume that you've all seen Wall Street, that was looking at the excesses of the 80s, Gordon Gekko. And in simple terms, over the last probably 5, 6, since the early noughties began anyway, there's been similar excesses, as we'll hopefully learn from our past mistakes. So we've had excesses in liquidity, in leverage, and in lending, and lax lending standards. So if you look at those 3 excesses, that's what's really contributed to the bubble that Glenn was sharing about. So in terms of liquidity, there's been such a flood of money in the markets that they've been looking for homes to invest those funds. And so one of the places of those funds has been in distressed debt in corporate circles. And so what we've witnessed is an increase from approximately 30% at the beginning of the noughties up to about 56% in 2006. 56% of all new issues were in distressed debt. So already we've got a significant portion of all this excess liquidity funneling itself into new places of distressed debt. Similarly, in the housing markets, they've been looking at opportunities for increasing their lending books. And so vis-a-vis, they introduced the concept of the subprime borrowers. So LVR rates were lowered, and then all of a sudden here in Australia anyway, we had 100% borrowing from government agencies with very little lax lending standard. I'll come to that. So we've also seen a substantial growth, somewhere in the vicinity of about 10% to 20% now of all originations of really subprime. That was at the beginning of the global financial crisis. So one of the excesses that I was speaking about was liquidity. There's such a flood of money in the markets, and they've been funneling themselves into distressed debt. It's not just restricted to the US. Okay. So number one. Number two is the leverage that Glenn was sharing about. The banks have been looking at ways and means of gearing and increasing the size of their lending book. So enter securitization, and enter insurance in the form of CDSs, credit default swaps, enter insurance companies like the American Insurance Group, AIG, and that's a big part of the equation we'll look at the moment. But in terms of the actual leverage, banks leverage themselves from approximately 18 times the asset base to their equity to 30 times, and that's in the States. Now if we look in Europe, Europe is substantially higher than that. If you look at the bastions of the banking circles from Deutsche Bank, which had a ratio of about 50. If you look at Bank of Tokyo, Japan, which had a ratio substantially higher. And you come back to the States and you look at Fannie and Freddie, and they had 100 times. Which is, the level of leverage that these banks have is phenomenal. And it was enabled by these new instruments that were introduced through securitization and insurance. So we had the excess of liquidity, we had the excess of leverage, and then we had the excess of lending. And so all of a sudden, with a pressure and a change on all the individual lending officers, which have moved from risk managers almost to relationship managers, with the introduction of customer relationship management strategies. There's been a big drive in terms of looking after their customers and giving funds and money to their customers that perhaps in the traditional times they wouldn't have been able to do. And so we've had those issues around LVR rates that have substantially changed, and a range of other types of things. Also, covenantal restrictions that haven't been monitored for many of the loan obligations that have been in play. What has all that led to? Obviously, it's led to the commencement of a lot of defaults. And it started with the subprime mortgage. But when you look at the broader context, a lot of companies have been heavily gearing, particularly when you look in the States. In 2001, it had the cash rate was around 6.5%. In the space of 2 years, it fell 550 basis points, down to 1%. So by 2003, with interest rates at 1%, enabled a lot of organisations to heavily gear. And we've seen that here in Australia with gearing rates that have gone, and entities that have been growing in excess of their sustainable growth capacity, have been growing in other countries. So coming back to Vic's question, and that's the interconnected nature of the issue that we face today. While it might have originated from one issue, it was a much bigger bubble that was occurring. And the way in which these banks had been operating, they'd been aggregating all these subprime mortgages in the form of a securitization package. And they've been selling that not just to other US banks, but other institutional banks, merchant banks right across the globe. In particular Europe, which brought a lot of the exposure in the US subprime market. Approximately 50%, slightly under 50% of the total exposure was held in Europe. And Europe was very heavily leveraged. And here's the funny thing, leveraged also in the form of insurance, which was enabled through the American Insurance Group, AIG. So America found itself in a predicament that all of a sudden it had allowed itself, with the excess liquidity, excess leverage, and excess lending, it was in a situation that it had to really step in. That's where the government had to make a decision. To what extent do we involve ourselves in this situation and try and correct the financial markets, which are fundamental to the successful operation of any economy? So that's one of the key ingredients of that interconnectedness is the global trade of businesses right across the world. We look here in Australia and China, which 30% of China's exports were to the US. So when the US goes into recession, severely impacts China. And obviously, as you would appreciate here in Australia, that severely impacts us. China is one of our close trading partners and a very important trading partner. And that impacts obviously the necessity and need for commodities and resources, which is one of the fundamental cornerstones of the Australian economy.
So one element of the recession is the fact that these toxic mortgages or collateralized debt obligations are sold around the world. But the other aspect is that as each economy starts slowing down as a result of that primary impact, then you have the secondary impact, for example, upon Australia, that China does not find that it has the demand for its products, so it doesn't produce as much. It cuts back on ordering the resources from Australia, so Australia also has a downturn. So in some sense there's a primary and secondary effect in terms of these impacts of the financial crisis. A question that I have, which is probably more for you, Brad, one of the criticisms of the subprime, you could say, meltdown was the fact that some of the financial analysts say that ratings agencies have some part of it, that they may be responsible for perhaps rating in error some of these CDOs and CMOs, in other words, the